Hello, everybody, and welcome to this Q3 2024 quarterly conference call. I'm Jeppe Kirk Bonde, the most copied popular investor on eToro. If you want to use this presentation for anything, please go ahead and read the disclaimer here at the bottom really carefully. So in this presentation, I'm going to go through my background, my investment strategy, my portfolio, and then finally the many questions that I've received. One of the main reasons that more than 25,000 people are copying my portfolio on eToro is that since 2013, I've had an average annual return on investments over 25%, which is really better than anyone you could fairly compare with, and also with a very good return to risk ratio. If you want a higher return than that in that period, you would effectively have had to take on a lot more risk. My background is from management consulting. I did my university degree in political science and finance. Then I worked as a management consultant, advising some of the largest companies in the world, including in tech, telecoms, aerospace and defense, and banking. And then as I was doing that, I was making more money than I was spending. And so I wanted to invest my money. And then I evaluated what my pension fund had to offer, what my bank had to offer, and I was frankly quite unimpressed. My pension fund, for instance, were only investing in Danish companies and in Danish bonds and Danish government bonds and Danish real estate projects, but basically Danish. So I thought, okay, that's like no geographical diversification at all. So I was quite unimpressed with that and thought, okay, I can definitely do better myself. And then I made a spreadsheet and put in all the different investment platforms and then started comparing them. How good is the website? How good is the app? How much do I like this company? How are they changing over time? What kind of financial instruments are available? What are the fees and so forth? And then I scored all the different investment platforms and then, weighted up how important each of those factors were and got a total score for each. And then eToro came out on top, and then I started investing on eToro. And then as I was investing on eToro, my investments did very well. And then, initially 10 people started copying me, then 100, then 1,000. And then eventually I then quit management consulting to just focus only on managing my investment portfolio on eToro. And then that's what I've been doing since 2018, just managing, but investing on eToro since 2013. And today, 26,300 people are copying all my investments on eToro, and for a combined $82 million US. So I don't do everything on my own. I have a great assistant who helps me. I have a very good network of experts that I trust on different topics. If I invest in something, I must either myself be an expert in it or know someone who is, because otherwise I can't get the most important insights quick enough. And then I get really strong support from eToro. Whenever I have any questions or concerns, there's always someone from eToro who can be, the right person to help me get that thing fixed quickly. Then I subscribe to all the best data providers and have the best IT tools so that anything that can effectively be automated is automated. And finally, I'll highlight my three favorite experts, which are my brothers. My one brother, he is the CEO of a marketing company. One is an economist with the Danish Ministry of Finance. And the last one, he has his degree in computer science and is now working with effective altruism. And so they're sort of my favorite experts. And my investment strategy is based on some principles that have been there all along and continue to be here. I focus on macroeconomics, so looking at what kind of growth rates I expect different pockets of the global capital markets can each have. I focus on megatrends, so these are trends that can grow by more than 10% for more than 10 years. Then I focus on fundamentals, conducting very careful, deep company analysis, trying to understand what is their management team like, what's it like to work there, what's it like to be a customer there, what's it like to be one of their suppliers, what kind of products do they have, what kind of services, what do the customers think of these products and services, what have their financial statements been like through time, what is it like take to compete with this company, what different strategic options do they have, how is their technology stack, what could this company potentially do if the world goes in this direction versus that direction. And based off of all of that, I conduct very detailed valuations to really assess what do I think this company is worth based off of predicting how much revenue and costs and in total profits can they have year by year, far out into the future. What's that worth to me today? And based off of all that, what do I value the company at? There's a great quote by Warren Buffett that price is what you pay, value is what you get. And I subscribe to that view. I like to buy companies that I have carefully valued to be really valuable and can buy in the market at what I deem to be a really good price. Then I focus on the long term, which is sort of the most usually difficult one for people to really grasp. There's a great quote by Benjamin Graham, who is the sort of mentor of Warren Buffett and the author of the famous book, The Intelligent Investor. He said that in the short term, the market is a voting machine, in the long term, a weighing machine. And that effectively means that in the short term, it can be important what other people think. But in the long term, if a company becomes really big and profitable, then that company will also be worth a lot. And I have the patience to wait around for that to happen and sort of the stomach to ignore the noise along the way. Then I focus on risk management, diversifying across different geographies, different industries, different business models. I have a lot of hedging in the portfolio. So if something was to materials that would be really detrimental to some companies, it would potentially be beneficial to some of the other companies, thus rendering that effect less important for my overall results. And finally, I stress test my portfolio, evaluating what I think different companies can do in different extreme scenarios. So if there's some thing that might be very unlikely to happen, but if it does happen, it could have a very big effect, then I want to make sure that I have at least some companies that could then really gain from that and save my portfolio in that situation. Finally, I focus on keeping the fees low because that's just one more way you can squeeze a bit more profitability out of one portfolio. And copyists pay the same fees that I pay. So if I keep my fees low, then copyists keep their fees low. Then there are some areas where I generally see great opportunities. I love companies that have strong organic growth, that are selling more products, are able to increase the price of their products by more than the prevailing inflation rates. But it does not really include companies that just grow through acquisitions. So sometimes you'll read at the beginning of an annual report that, oh, we grew revenue by 2% this year. Like, yes, that's nice on the surface, but actually that's just because you acquired another company. The core business actually shrank by 4%. So what you've accomplished is really not that impressive. On the other hand, there are companies that are able to drive a lot of organic growth after completing acquisitions. So, for instance, when Facebook bought Instagram, they were then able afterwards to really expand upon Instagram and make that into the massive success it is today. And there are some companies that are really good at sort of taking all that they have and then buying something and then using all they have with that to create those synergies and actually drive a lot of organic value from that. And then I love companies that are resilient, meaning they can do well in multiple different scenarios, not just in one favorable scenario. That includes companies with really strong balance sheets, companies that have a strong competitive advantage where potentially they're already in the pole position in their industry. And even if they're not, they might have sort of a great route to get there. And if they are there, they might also have a great way to sort of stay there and make sure that others can't just come in and steal their cake. Then I like companies that are truly profitable, that are delivering real value year after year, and ideally can reinvest that profit into themselves to grow themselves further over time. Then I like to invest in companies when they have a new strategy. It has, of course, to be a good new strategy, one that I believe in, because when you get a good new strategy, sometimes you end up paying the price of the old bad strategy, but you're getting the value of the new strategy. It's not enough for me that a company go out there with an announcement that they have a new strategy. I need to see some kind of real steps that prove they're serious about this new strategy. So whether that's changing the company name, changing the CEO, buying something, selling off a part of the company, launching a new product or something that really tells me, okay, this is actually happening. It's not just sort of words on a page. Then I like companies that make great products and offer great services. Sometimes you don't have to predict the far future to see that a company is good. You just have to sort of see what they're actually doing. A great example of failing at that was when Steve Ballmer saw the announcement of the first iPhone, and he said, "Oh, look at this iPhone! It's too expensive. Business customers won't like it. It doesn't have a keyboard. I'm very happy with our position." And he was, of course, proven completely wrong by the massive success of the iPhone following that. And that was just an example of staring that blockbuster product in the face and just not seeing it for what it is. And many people have recently made the same mistake with Tesla, and might now be doing it with Nvidia. And effectively, if you're a smart shopper and you're able to buy the right products, understand like why it's sometimes worth paying more for something, because well, those features make it more valuable and you should pay more for this because it's worth it. And other times, right, here you can get a discount because actually all of these things aren't worth it. Really understand where you're getting a good deal. What is a great product and a great service in this context? And if you keep making the right purchase, maybe that hints that you're good at understanding products and services. And if you keep having to, buy a new product because you bought the wrong one, then maybe it's not so good. And if you don't understand products and services, I would say it's very difficult to understand companies, which are ultimately what we are investing in here. And if you do understand products and services, well, that's sort of one piece of the puzzle. You fit it in, and then yeah, that's a great start. I like companies finally that are mission driven, not just because I sometimes believe in the mission, but because it can be a great way to attract and retain and motivate, and you would even say energize really smart, hardworking people. And you have some companies where even if they're overpaying and trying to hire people from other companies, they just can't get the best ones. And if they by accident somehow end up with one of the best persons, then those people, they will sort of leave after a while. And whether companies are sort of, an absolute magnet for talent, or, sort of a reverse magnet pushing everybody away, that might not show up in the financial statements next quarter, but sort of a couple of years down the line, you can probably start to see quite a big impact from that. Then my portfolio on eToro is primarily invested in stocks. That makes good sense because historically stocks have been the best performing asset class. Now, property has been okay as well. I have a property that I rent out. Many people probably own the house. Many people that copy me own the house or apartment they live in, maybe have extra property they're renting out. That has historically been okay. I think with not as great population growth in many key markets in the future, it's not as great. It's not that it's not the only factor, but bonds have historically been medium good at current levels of interest rates, which are a little bit higher than recent, but also with inflation still a bit high. Bonds are not looking super attractive to me. Commodities have historically done next to nothing. In recent decades, it's done a little bit more, but ultimately, if you had a gold bar during the Roman Empire, then that gold bar would remain a gold bar, and today you would still just have that gold bar. It doesn't give birth to any little baby gold bars. The gold bar doesn't go out there and expand itself, and that's ultimately the problem with just investing in commodities. Finally, currencies have historically been terrible because, of course, governments like to increase the amount of currencies, whether that's done physically or digitally. And then with inflation, currencies just tend to not do very well over the long term. And so currencies have historically done poorly. They're currently doing poorly, and probably in the future, they will also continue to do poorly. So whenever I have an excess amount of cash, I like to get it transitioned to the left of this chart and ideally into some stocks. Then there are some big factors that really drive economic growth in the world over the long term. Firstly, I like to focus on, I like to split up into the physical, the social, and the technological realm. So in the physical realm, I like to look at nature, how many trees are in different places, how much oil and coal and different kinds of metals are in the ground, where in the world. Then I look at life, animals, but especially humans, how many people of which age groups are in which places, the companies that have the, and how are those demographics changing over time, the companies that have the right products for the right demographics in the right places, of course, have an advantage. Then the realm in which the most value can be created or destroyed the fastest is really in the social realm. So one of the most important things in markets is the concept of trust. When you have a US dollar bill or a deed to a property that proves you own this property, you have some numbers on a screen that show you own something. All of these are social constructs. If we believe in them, then we can use them to trade with one another and thus cooperate with one another. And it's that cooperation that creates so much value every day that our belief that that can continue really has sort of an outsized effect on the world. And if we stop believing in some of these instruments, then that can make all of that cooperation and trust dissipate, and then that sort of can suddenly cause a lot of value to be destroyed in a very short amount of time. Then you can ask yourself, why do we humans really value anything? If it's very sort of logical for most people why a house or an apartment has value. It's made out of bricks or out of concrete. It's very tangible. You can really touch it. So obviously it has value. But fundamentally, if humans didn't want to live in houses anymore, and we didn't want to look at houses, and we all just wanted to go camping, then houses wouldn't have any value. And um, sometimes what we humans value changes over time. And even if something's just changing, in a, small part of society, but at a high rate, then that can suddenly expand, and suddenly, that can really start to creep in all over society. And if you can get in on the right investment at the right time for that, it can really be the basis for really good investment. Then finally, there's the realm of technology. Firstly, in the scientific realm, all the way from the deepest pits of the research and development labs to the sort of end stages of innovation where customers are tweaking how they're using the products. All through that value chain, there's massive opportunities for value creation and great investment. The most important of these are the big foundational technological shifts. So for humanity to go from just hunter-gathering to agriculture to the industrial revolution, getting the internal combustion engine, then getting electricity, getting to the digital era, and then the internet era. And now we are living through the next big foundational technological shift with artificial intelligence. Then from those big factors that drive long-term economic growth, we can see where the economy is today. So firstly, in terms of GDP growth, the world is generally looking okay right now. Not, we're sort of back to normal. We've more or less recovered from COVID, and in terms of growth, things are okay. It's sort of booming in India, but the growth in India is very unevenly distributed, and we have to sort of accept that the EU is, not growing as much as it potentially could. In terms of unemployment, things are looking better than they were even before COVID. Unemployment is still very low compared to historical averages in the US. However, what concerns many economists is that it has been growing for now 3 months in a row. So it's still at a very low point, but that sort of growth in unemployment is sort of something to look out for, and something, if it continues, then eventually the Federal Reserve will have to deal with that, because of course they have a dual mandate to maintain a good level of inflation and unemployment, and they don't want to find themselves in a situation where they are basically failing on both those metrics. In terms of interest rates, these have come up quite significantly since the lows that were achieved right after the financial crisis, but they're still quite not quite low, but they are approaching sort of historical level, but still pretty low compared to the long-term historical average. And effectively having raised interest quite a bit provides more firepower in case there suddenly is some kind of shock. Effectively, you want to have a central bank that's in a position where inflation is low and the interest rate is high, so that if something happens, you can sort of like do a lot of you can lower the interest rate, and you can do other things to provide more liquidity for the economy and loosen the monetary policy to come to the aid of the economy. And you really always want to be in a situation where that we don't know what kind of issue will arise, but whichever one it is, we know we have the firepower to handle it. And in terms of inflation, we are unfortunately not quite there yet. So while inflation has come a long way down from the peaks that were hit right after COVID, they're still hovering at 3%, and there's of course a worry that they will be sticky at this level. So getting from 8% down to 3%, maybe that would actually in the end be easier than getting from those 3% down to 2%. But the fact that it's been going in the right direction is sort of something to be happy about, in the same way that the unemployment going a little bit up is something to be worried about. So that's sort of what economists are very much keeping an eye on. And then it's a constant sort of tit for tat game of, if these numbers go a little bit in the wrong direction, that's very bad. But if they go sufficiently in the wrong direction for that, so that it's so much that the central bank really have to make a strong reaction towards it, then it can sort of, drive that the assets you would have if it only went a little bit in that direction are not the ones you would want to have if they went a lot more in that direction. So that's sort of where the global economy is right now. Then there are some mega trends that I've identified as extra interesting. So if a company is riding on the wave of, or really driving one or more of these megatrends, then it's more likely to be found in my portfolio. So firstly, I love the nice to haves. So when we humans, we have it all and we don't have to be out fixing all sorts of problems, then we can enjoy ourselves with fun competitive games and surrounding ourselves with luxury and so forth. And that's obviously very nice. And there are great companies delivering great profitability and growth within these areas. But the nice to haves can only really stand on the shoulders of the need to haves. Without energy, you can't build any of these things. Without security, you don't get to decide whether to have the nice to haves. And so the companies that are key to delivering the future of energy and security are also found in the portfolio. Finally, there are the enablers and accelerators. So the things that make us able to do these other things faster, better, cheaper over time. And chief of these are AI. The companies that have been gaining the most, and I think some of those companies that are to gain the most in the future from the rise of AI, they make up a very solid chunk of the portfolio now. And the companies that will deliver the next great generation of devices we'll all be using in the future are also in the portfolio. Then when you want to zoom in on a specific group of companies, maybe companies in one industry or in one country or in some other grouping, then a great way to get a quick overview is to look at the multiples. So this is an example of that using the Mag 7, the 7 large American tech companies. So Microsoft, Apple, Meta, Tesla, Nvidia, Alphabet, and Amazon. So if we start up in the top left corner, we can see that in terms of profit margin, all these companies are doing really well. Nvidia is doing the best, but Tesla and Amazon are lagging quite a bit behind. They are not losing money, but they're not making as much as they potentially could when you're looking at some of these others. Then in terms of growth rate, all of them are doing quite well, but Tesla and Apple are standing a little bit still, while Nvidia is absolutely growing like basically never seen before for a company of that magnitude. Then the two top charts here, the higher the better, because they're fundamentally about profitability and growth. But the two bottom charts, the lower the better, because they're effectively about price. So if we look at the bottom left corner, we can see that for every dollar that Microsoft delivers in profits, we have to pay $29 when we invest. So that's sort of okay, especially given that they're growing their company over time. But if we look at Tesla, we're paying $87 for every dollar of profit that they're making. So we'd only want to pay that much more for Tesla if we think they can, get back to growth or maybe boost this profit margin or something. Otherwise, we wouldn't want to be paying that much more for Tesla. And then if we look at the bottom right chart, we can see that for every dollar of revenue that Microsoft is bringing in, we have to pay $13 when we invest. For Amazon, we're only paying $3, but Amazon is also getting a lot less profitability out of every dollar of revenue, also growing at a little bit less. But for Nvidia, we're paying $36 for every dollar of revenue. Now, that's certainly a lot, but we're also getting more profitability out of every dollar of revenue, and they are growing that by a much, much higher percentage than any of the others. So that's sort of a way to get a good, quick overview of how companies stack up against each other. Then if we look, I typically look at large data tables all day. So they'll look something like this, coming in either automatically from all my data providers or coming in as data sets that I update manually or my assistant updates manually, where it's numerical numbers, but it's subjective. So it could be something like I evaluate how much I like this factor about the CEO on a scale from 0 to 100. And then that's numerical. I can use that in combination with all the data that comes in automatically to make my analysis. So these will either be valuations or they'll be risk scenario analysis. So evaluating how much do I really think companies are worth. With every company that I analyze, I don't just learn sort of what that company should be worth. When I 11 years ago made a very deep, long valuation of Facebook, I didn't just learn about Facebook. I also learned about concepts such as social media advertising, and then that helped me to think, oh, when I look at other companies in the future, maybe I should check out their social media advertising and see how good they are at that. And with every company has something that's unique about them. So every time you really analyze a company, there'll be something that then helps you to see other companies in a different light. And as I do valuations of companies and stack them up to see which one I should be invested in, I get to make decisions. So these will most often be research decisions. So I see a company is doing something new. I need to learn more about this. As I learn more about this, this might change how I want to financially model the world. That might then change the outcomes of my analysis, which then might lead me to look at something else, which I then have to research. And then that just goes around and around, gathering the input, changing the way I look at the world, doing my valuations and my risk scenario analysis, making more research decisions and so forth. And then as that cycle spins, it keeps adjusting what companies I think are the most valuable ones compared to the price that can be fitted nicely together to create a total portfolio at my risk appetite. So the amount of risk that I want to take, that I think here I'm getting a very high return without taking too much risk. And then whenever that's not what I have in my portfolio, it means I need to make an investment change, an investment decision. So that can be, oh, there's a company I have, but I should have less of it, so I'll sell something. Or there's one that I don't have, but I should have it, so I have to sell something else to buy it. And then I make my adjustments as I go. And then when you add up all those investment decisions, then that becomes my portfolio. So you can always go in on eToro.com or on the eToro app or on a website called Bullaware, from where I pulled this chart of my own portfolio, and see exactly what I have in the portfolio and what percentages. And we can just highlight that right now my largest positions are in TSMC and Iberdrola and Nvidia. Then if we compare my portfolio with the US economy, in the US, it's not just one industry where there is economic activity and growth. There are those things across many different industries, and there are great investment opportunities across many different industries. So in the US, property, professional services, tech, manufacturing, and health are the biggest ones. In my portfolio, I'm slightly more exposed to tech, climate and renewable energy, aerospace and defense, metals and mining, and semiconductors. In terms of geography, if we compare my portfolio with the world, I'm slightly more invested in North America and in Europe, and slightly less in Asia. And compared to the total market cap and GDP of the world, I'm also, quite significantly less exposed to China. Then that was my initial presentation. Now I will go through the many questions that I've received. So firstly, will changes you make automatically be copied by my portfolio? So when someone starts copying me on eToro, then they will, to the extent possible, invest in the same assets that I've invested in the same proportion. So if I have invested 1% in Apple, then eToro will automatically make them invest 1% in Apple. Now, if you start copying on, say, a Saturday, then you cannot open those Apple positions until Monday. But as soon as the US stock markets open on the Monday, then those positions will be opened. And then when I make changes to the portfolio over time, so maybe I decide I no longer want to be invested in Apple, so I sell Apple, then copiers at the exact same time automatically also sell Apple. And then when I instead, let's say I take that money and I invested in Nvidia instead, then copiers will also automatically at the same time invest in Nvidia. And when those companies pay dividends, then we receive those dividends. And then when I reinvest those dividends into another company, copiers also automatically do the same. How should one manage US dollar currency risk? So in general, there are many, many small and medium-sized risks to portfolios in the world and to one's life. If you insure yourself against every small and medium-sized risk, you will overall pay so much in insurance premiums that you will end up with not as much money as you could for the same amount of total risk taking. Effectively, for a lot of insurance, it's almost nicer, rather than sort of protecting yourself, to actually just invest in insurance companies and sell protection to others. That's sort of long-term a better business. In terms of currency risk, in the portfolio, we have many assets from different countries that are earning their money and having their cost in different currencies. So that's one total amount of currency reduction. That's when you have a total portfolio. But for some individual investors, that can be very extreme situations. So if you are someone who has all of your assets and income in US dollars, but you have all of your liabilities and expenses, say, in euros, then that can, make for an overall quite extreme scenario. And generally, with currency risk, you want to look at your total life currency risk. So if you're in that extreme situation, then of course, if the US dollar goes up a lot, you'll be very happy. Your assets and your income suddenly are higher relative to your liabilities and your expenses. However, if the opposite were to happen, the US dollar goes down a lot, maybe the euro goes up a lot, suddenly you see that your liabilities and your expenses increase and your income and your assets go down. And then you can take a currency position and say, okay, given that I really want the US dollar to go up, I'm going to actually bet that the US dollar is going down with my currency position. Because then when the US dollar goes up, you're like, great, that's good for everything else that I had, but I lose a lot on the currency position. But vice versa, if the US dollar suddenly goes down and you're losing in everything, then at least your currency hedge is then going the opposite direction. And then that can be a way to sort of even it out. But again, it costs fees to keep such a position open. And that's just one risk you've now diversified from. So you've got to really evaluate, is this really a large risk there where you need to take this kind of protection from? Or is this a small and medium-sized risk where you should really just be wealthier in total so you can afford to take that kind of risk and then accept that kind of risk? And then, you get good years and bad years. And then over the long term, those little and medium-sized risks even out. Having saved the premiums all along, you're left with a much bigger amount of money. Is there a new NVIDIA out there? There is currently an NVIDIA, and I think the future NVIDIA is NVIDIA. I think not only are they the most amazing company in the world, they're also really at a high pace, moving further away from the competition. So I think, it's very tempting for many people when they see a company has gone up a lot in value to say, right, okay, that's already gone up. Let me look for the other thing. But that's just the way that you end up, sitting there with Snapchat when others had Meta, just because, you couldn't accept that Meta was such a great company at the time. Or I don't know, people 100 years ago not choosing oil because they were like, oh, but oil is already good now. Let me find something else. Sometimes something that's great and is doing great can continue to do great. It's not a law of nature at all that what goes up must come down. There are great companies that continue to go up. And I think NVIDIA has just gotten started. So I wouldn't look for another NVIDIA. I would just actually pick NVIDIA. What are your views on NVIDIA? So I think it's the most amazing company in the world. I listen to absolutely everything Jensen Huang has to say in detail. And I think I'm very happy to have that as one of the biggest positions in the portfolio, because I think there are many scenarios where, especially with different levels of progress for artificial intelligence, NVIDIA can really carve out a very, 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 very large future market that will just never have been has never been seen before. And that when we get to that stage, there's no sort of, people have this idea, oh, now a company is very large to other company relative to other companies, so maybe they can't get any further. But there's no sort of upper limit for that. You can really, really become a truly huge company, and I think NVIDIA will become just that. What are your views on Taiwan's semiconductor manufacturing company? So that's the largest position in my portfolio. I really, really love this company as well. And again, I think that the competition is not really catching up. They're falling further behind. So they're already in an amazing position. I think over time, they'll be able to adjust their prices upwards a lot and continue to sell even more. And there's a very strong case to be made for a big future chip boom, and they'll be sort of in a really good position to profit massively off of that. What are the minimum and recommended amounts to start copying your portfolio? So the minimum amount to copy with is $200. You cannot technically on eToro copy with anything less than that. On average, copiers copy with about $3,000. The maximum is $2 million. Many large investors copy with more than $100,000. And so it really depends on the individual. If you already have a lot of debts that you're paying a high interest rate on, it might be better to pay that off than to even, start investing in stocks at all. And so you can really, the recommended amount would be different from every individual. And I don't have sort of the capacity to go and review every individual's situation. Is now a good time to invest? So now I evaluate it's a great time to invest. I have invested in the assets that I think are currently the best ones to have. If I thought that now it's best to have a lot of my money in cash, or I should have everything in gold or something like that, then that's what I would have. So currently I have the assets that I think are currently the best assets to have. And when you copy me now, then now you will have the same assets that I have that I think are the best ones to have right now. And then if say tomorrow I want to have something completely different and I make a significant amount of changes to the portfolio in the short term, then, that's also going to be reflected in copiers portfolios. What do you think of First Solar? So I think that's another really amazing company. I think there's a lot of competition, and there's gonna be a lot of competition in the future in this industry. I think First Solar has focused on the right things, and that's really what's put them in a position to have a very strong, solid growth, reasonably profitable business right now, and with significant upside if the world at some point again has the capacity to get serious about climate change. Climate change is an issue that can be the world's #1 priority, but in a world where in any particular country, if you have a lot of problems with security, immigration, the economy, or something like that, then voters will tend to think that's more important, and then climate change gets deprioritized a little bit. And we are still in a stage where for solar power to really reach its full potential, and for a company like First Solar to do that within that, a little bit more support for some time is still it would still be really, really beneficial. Do you plan to start short selling? So no, in general, I'm really not a fan of short selling. Effectively, when you buy a stock, say you pick a random stock markets have historically given 7% real return per year. So what should you expect from that random stock you picked? Well, 7% plus your skills in picking plus your luck. So that's sort of the formula for your return. Okay, but what about short selling? Well, given stocks have on average historically gone up, and stocks in the future probably on average are going to go up, then you're starting from -7%. So you get -7% plus your skills plus your luck. So that means that you got to be extremely skillful or lucky to just do as well as someone just buying shares. So that's a really bad proposition to start with. And now then there's further things that make it bad. Now, as you keep open your short position, you actually have to borrow money to keep it open, and you'll be paying interest on that. So you're paying interest on it. Not nice. Then you have, when you're buying a stock, something called limited liability protection. So that means if the stock goes to zero, then that's it. You can't lose any more money. The money that you invest in that company are gone, but that's it. But there's no such limit under a short position. A company can become infinitely big effectively, or not infinite, but extremely, extremely big. So if you had shorted the company like Nvidia because you were like, oh, blah, 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 and they won't do well shorting them, then that position can, rack up such huge losses that it will wipe out the rest of your portfolio. So not just did you lose your Nvidia short position, but you lost your entire portfolio just from that one short position. That's super dangerous. That's a risk that I don't want to have. So you have something that can add a lot of risk to your portfolio, and also give you a lower average return. You can hypothetically do some things to make it a little bit okay. And hypothetically, if eToro in the future add put options, then that could be another way where I would potentially start taking some short positions. But as it stands, I would not do any short selling. Will the current investments in AI infrastructure pay off for big tech? So I think, yes, definitely. I think it's a little bit hilarious when some of these investment bankers are talking to, the CEO of Microsoft and CEO of Amazon during the quarterly earnings calls, and they're so worried about this. Like Amazon and Microsoft have been investing in infrastructure for a long, long time, breaking up huge business from this. I think they know a little bit better than these analysts what kind of things their customers will want to pay for in the future. And I don't think they're making these kind of infrastructure investments with sort of their eyes closed or anything. I think there's if you don't build out this infrastructure now, as we're not building out the capacity to produce more infrastructure fast enough to meet the future demand. So I think at the current prices of buying this infrastructure, you're getting an extremely good deal. And so they'll have some extremely attractive infrastructure that they'll be able to either lease out to customers as an at a really good price going forward for many years, or utilize that infrastructure for themselves to utilize AI for the different things it'll be capable of doing as we progress the technology. Should we vote our shares even though it's unlikely to change outcomes? So I think when you have a political election, say you're voting for the European Parliament election or the upcoming US election or your national election, you're not just voting because you think your one vote will change the outcome. You're also adding sort of to the total vote tally, which is sort of a way of stating that you support democracy. And if we have a president that's elected by a large percentage of the voters, it's sort of also saying, like, even if it's not the president you like, right, we're all we're all sharing in this endeavor, that this is the leader for us. I don't think you have the same obligation when you're a shareholder. Like, we all are investors in Apple, and but I don't think you have an obligation to steer the ship of Apple. It's your money. You've invested in Apple, and you are free whether to vote your share or not. I don't think you have any moral obligation to vote it. I think sometimes it can actually be, nice to vote your shares. We had this extreme example where some large institutional investors, including the oil fund of Norway, they wanted to basically screw over Elon Musk and not let him have his extremely fairly earned compensation package that was deemed ridiculous when he originally was granted it, and then when it was finally time to pay out, they didn't want to do it. And then it was really nice that so many small investors came out to vote in favor of Elon Musk's pay package, and yeah, not save the company, but and I think I voted my shares. I'm very happy that I did, and also I remember that as a nice thing of going in there and voting my shares and saying like, oh, I'm part of doing the right thing here. What are your thoughts about Novo Nordisk? So this is a company from my own small hometown in Denmark that has become the largest company in Europe, and me failing to invest in that company is the biggest embarrassment of my investment career. I still don't have it in the portfolio. There are many great companies that will probably do really well in the future that I won't have in the portfolio, and that's just too bad. And yeah, this is just the one that's the most painful for me. But it's obviously an amazing company. The growth is tremendous. The profitability is really, really good. So it's something that maybe one day I'll have in the portfolio. But yeah, there are other companies that I think are even more attractive. But yeah, not having this in the portfolio early on, even as I know people that work there, and everybody's been telling me this weight loss drug is going to be amazing. I should have listened. How will the US elections affect the market? So both, even though everybody hates Trump, many people do, sort of, we have had him for 4 years, and in those 4 years, things were sort of okay. I very much disagree with his sort of his approach to climate change, sort of denigrating the issue, saying that climate change is a hoax, having that sort of attitude. And so I think on that very specific point, there can be a material difference between the two presidential candidates. Very often, the difference between the Democrats and the Republicans are more in what they say than in what they actually do. So one will say, we will go this direction, but they only go a little bit in that direction. So we will go in the other direction, but they also don't really go in the much. And then you end up with the difference not being that material at all. But in terms of, there's the potential that on climate change there could be a material difference, and then there would be some companies that would potentially lose a lot of money or make a lot of money based off of that difference. There are other areas where there are big differences as well, and there are some specific companies for very specific reasons that could benefit a lot from one candidate or the other. If I, for one reason or another, suddenly come to believe that one candidate is much, much more likely to win than the other, then that will reach a point where that has some influence on some of the position in the portfolio and would cause me to make some changes. What do you think about investing in water and water treatment companies? So there are some great water treatment companies. I had one in the portfolio. I don't have it anymore. I think however this question is really coming at is sort of and many people have come to this wrong belief that the world is running out of fresh water. Fresh water is the new oil. We need to invest in fresh water. And no, desalination prices have come down really significantly. We could just produce as much fresh water as we need. There are droughts in certain countries. There are certain areas where, yeah, you definitely need more fresh water and you need to make some investments to fix some things. But fundamentally, globally, Nestle isn't secretly hoarding all of the fresh water, and people investing off of that, they're just sort of making idiotic investments. What do you think about solar energy? I love it. I think it's a great form of energy. For every country, you can sort of look at the current energy production and then sort of a realistic target level of production in the future. And for many countries, you have some kind of sensible mix of different energy production methods that makes good sense. When the wind isn't blowing, maybe the sun is shining. When the sun isn't shining, maybe the wind is blowing. And so you'll have different energy types that can produce at different times and help you sort of smooth out the energy production. Then you have, with the growth of batteries in the future, potentially more people having electrical vehicles with some batteries and other battery technologies coming in, that can help you also even out prices a little bit more over the course of the days and over the course of the seasons, and also from sort of good years and bad years. And with that, it will matter less that there are some energy forms that are less flexible and less constant in their production level, because then the batteries can help you even it out. And that comes in as a really big benefit for solar. And if any of the cost reduction trends continue as well, then I think this can be a really, really amazing industry for the world. And there are some companies within the industry I think can also make a lot of money from it. What are your views on gaming stocks? So there are many that I really, really like. I think gaming has a great future. It's a great hobby that more and more people will pick up in the future. And there are some companies that can really, really, continue to grow and make money in this business. And the best ones are to be found in the portfolio. Why did you close your Ferrexpo positions? So it's a company I've had in the portfolio for a long time. Obviously, it's come through many severe issues, both with the management team, also with sort of the core end market, and finally with the it being a Ukrainian company becoming Russia attacking Ukraine is not exactly nice for a Ukrainian company, and then for various reasons, it's also a very small company, so it's just become more and more difficult to really have in the portfolio. I still think it's a great company. I still think it can potentially make investors a lot of money, but I don't think it's really suitable to have in my own portfolio right now. How will you address the sector rotation from tech and AI to small cap and industry over the next 6 to 12 months? So I don't think there is such a sector rotation over the next 6 to 12 months. So I will not address it in the way that I don't think that's the most likely scenario coming through. In general, I prefer larger companies over smaller ones. Different time periods in history can cause the world to go more in one direction or the other. But I don't, a lot of people, they really love startups and think startups are really cool. I don't like startups at all. I don't think that's a great way to do business. I prefer large companies in general. And I think the companies that are very, very large, they can become even larger. And yeah, so I think a lot of people who, also one reason many people try to diversify out is they don't, they think like, we have too much concentration in some very large companies now. But actually, if you have a very large company, say like Berkshire Hathaway, they actually invested in many different companies. So even though it's one company, your total amount of diversification is still pretty decent because they invest in so many different kinds of companies. Then you have extra CEO risk, or you say if the CEO of all of this is really bad, but then you can sort of still that's a very company specific risk, so that you can even out across many different investments. So I think I don't think you need to rotate out of tech and AI. And I think because tech and AI are so amazing in terms of the growth and profitability, there are many scenarios for the future where they will really make a lot of money and just get bigger and bigger and bigger. And so the idea of like, if everybody else would be selling them out and not believing in that, and if I still believe in that, then I will just use that to buy more. That's sort of but I don't think that that's going to happen. But if that does happen, then I would, if people were to start selling these stocks without a really good reason to, then the price would come down. I would buy more. But hypothetically, the stock price could come down for a good reason. It could be maybe there's going to be more competition in this space. This new kind of regulation, or the Department of Justice actions are indicating wider things. And for any of those things, there could be some negativity. Finally, you also have something as basic as, now the central bank has to change the total amount of liquidity that's being provided to the economy, and this changes our expectation for that over the long term, and this changes to what extent you value companies where the profits are coming, over the next quarter, whether we have to wait, decades for that real big amount of money to start rolling in. If you have a very high interest rate, it makes the opportunity cost of waiting to receive your dividends higher, and then it makes companies where the big dividends will really only be coming in the far future, they make them worth less. Any thoughts on companies providing cooling for new AI chips? So I think this is, again, a sort of idea coming from people that believe in AI and they believe in this big future and in companies such as NVIDIA. but because they already maybe missed out on Nvidia, they're feeling like, oh, I want to invest in this, but I don't want to invest in this company that already went up a lot. So can't I find some other thing? Maybe the cooling for the data centers, because Nvidia, and all their customers, they will be big data centers, so they'll need cooling for these data centers. So, I can sort of make an AI investment without making an AI investment. And the thing is, if you look at the profitability and growth projects for these companies, they're just not as great in my view. So you can invest in these. I won't, because I don't think, like, if you really believe that this is happening, then invest in the companies that are actually gonna make the most money from it. Don't invest in like some sort of like safe feeling side bet. Like, actually analyze it. You really, is this your analysis, and that's your analysis, then go with that analysis. Don't be like, well, that is my analysis, but I don't really trust my own analysis, so I can't do something different instead. What do you think about the new fixed commissions on eToro? So I think they are very, very low compared to other companies still. And then I'm very happy that they are not applied for copy trading. So it makes copy trading relatively more attractive. So when you are copying someone else in eToro, then you don't pay these fees for that. But still, they're very, very small compared to what other brokers charge. And in total, it's always really important to be very mindful of all the fees. If all different investment platforms have different fees for different things. I've been very happy for a long time to have 0% commissions on stocks, and you go Sky invest mostly in stocks. And you just got to be aware of what's really, where you're getting some low fees, where there's some high fees, and then slightly do more of the stuff that has low fees and less of the stuff that has high fees. That's how you sort of over time make sure that you're not spending too much fees, because less fees means more profits. How will Middle East conflicts impact markets? So that can depend on the scale. And of course, in the most extreme example, any kind of conflict, no matter how small, can be big enough to pull the whole world on two sides into a massive conflict. And then you could say, is that then the cause of that specific conflict or wider things? For instance, a lot of stuff happening in the Middle East is a part of a wider conflict. I live in Dubai, in the UAE. We're very close to Iran, and there's certainly a lot of problems in the neighborhood that's one way or the other linked to Iran. And but Iran is not a complete sole actor. They have allies, and there's in when I look at the markets in the morning, sometimes before I check the news, I already know the news just because of how I can see prices have changed. So if I see something where certain impacts to oil and aerospace and defense, but without certain other prices having changed, I'm like, there's going to be some Middle Eastern news. And then when you check the news, like, yes, okay. And so those are some of the obviously in the Middle East, oil is relatively more important. So you take to the Middle East, like oil here, conflict like aerospace and defense, and then you could then take the flip side. What if actually we kind of work things out in the Middle East and we start to have a more peaceful region? And actually that can be a really good growth region for the future. There are a lot of young people there. It's, actually quite great opportunity. If you look at the success of the UAE, that can potentially be an inspiration for some other countries. I think there are some really interesting countries in the region that could potentially do really well in a world without conflict. So that's sort of, so while you can be really worried about conflict, I think you should also sort of be excited for prospects of peace. What are your thoughts on whiskey stocks? So I think that it's my favorite drink, whiskey. It tastes great, and there are companies that make whiskey that could potentially be really, really good. I don't currently have any whiskey stocks in the portfolio, and more widely, I don't have any alcohol stocks in the portfolio. I had David Campari back in the day that makes Campari and Aperol amongst other things. And yeah, but at the moment, I'm not invested in the alcohol business. What do you think will happen if the Fed decides to cut interest rates soon? So there's sort of two different answers. One is sort of, you say, okay, if they cut interest rates, all else equal. So nothing has happened to make them cut it. They're just cutting it, right? Cutting interest rates, that's a loosening of monetary conditions. So that will usually make stocks go higher. However, if you're cutting interest rates, but that was already expected, but at the same time, the Federal Reserve is also doing other actions that impact global liquidity, and those actions are, more restraining on the economy than people were expecting. Then you might see the opposite reaction. And if you then say, okay, well, they're cutting interest rates, right? Okay, that's a loosening of monetary conditions, but they're doing so because of some new developments. Say that, now unemployment has been going up for 3 months, and then we get, yet another month here in September where unemployment has gone up, but it hasn't just gone more, it's gone up by a lot. You're gonna be like, right, yeah, so they're cutting interest rates. That's great, but it's in response to something really negative. And then, then there might be, as the news hit, you will see firstly the prices of stocks overall come down, but then they'll go a little bit back up when it's confirmed that you get the interest rate cut, and then then that wobble may or may not be worthwhile to try to target for investors. For some investors it will, for most it won't. Are you considering to add more funds? So I generally don't remove funds from the portfolio, and I generally do not add funds in the middle of years. So if I add funds, it'll be towards the start of a year, and I'll always announce it well in advance so that copyists can evaluate what to do in response. And I'll also write some sort of thoughts on what copyists should think about in response to the fund addition. How should long-term investors set stop loss? So in general, if you know that, oh, if the market goes up and reaches this level, and I already know that if I, make this much money, I'm going to sell everything and move to an island somewhere. Okay, you consider take profit at that level. If you already know that if the market comes down by a certain amount, then you wouldn't want to be invested at all, right? Then you consider stop loss at that level. But in general, I think it's much better for most people in most situations to only invest what you can afford to lose, and do so without stop loss, because stop loss is a little bit like programming in an automatic panic sell. If the market goes down by 20% in price, right? What if the value has only gone down by 10%? Well, then theoretically you would want to buy more now, not automatically sell. So you have to compare how the value has changed with how the price has changed. If there is a company that has two factories, and then one of the factories burns down, you're like, okay, now the company is worth half, but the price has gone down only by 20%. You'd be like, or let's say, yeah, one factory burns down, the value of the company has been cut down by half, and then you see that the stock price has declined by 90%. You might be like, oh, I should sell it, but actually you should be buying more now, because yeah, the company is worth half as much, but you're getting, a 10x less price. So that's the time to buy more. So programming in an automatic panic sell is typically not attractive. And then if you really feel the need to set a stop loss because that's like you cannot afford to lose more than that, then maybe you should just be investing less instead of investing too much with a stop loss. Then it's often better to invest an amount that you can be financially and psychologically comfortable losing without the stop loss. Historically, do you think that the summer holidays have an impact on the stock market? So yes, there have been studies done on that, and it does. Something as simple as investors being on holiday, or individual companies will be selling more or less during the summers, and of course earnings have an influence on stock prices, but of course that's always in relation to what was expected. And if a company is always earning more in the summer, obviously that's not going to be a surprise every year to the market in aggregate. And so most of the sort of factors that you can read are different month to month, day to day, that are anyway basically cyclical. Those are already more than effectively traded on in the market. So you have no extra profitability from racking up fees for trying to adjust your portfolio towards this. You just have to ignore that to an extent, unless you find something that others have not found. Then if there's some summer effect that that others don't know, then potentially you can start evaluating, okay, is that such a big effect that it's worth trading on, or it's just that's such like a small effect? And hypothetically, if there weren't any fees involved in trading at all, then you could be making a little bit of money from that. But yeah, with even a little bit of fees, maybe not. So impact market, yes. Is that where I would go looking and spending all my research time to try to increase the profitability of my portfolio? No. Do you consider demographics when evaluating countries' economic prospects? So yes, that's a very, very important factor when evaluating countries. Although there is a very big difference, I think, in the future from the past here, in that in the past, one of the biggest assets a country could have is really having a lot of low-skilled workers. So it's like, oh, China, they can be a manufacturing powerhouse because they have so many low-skilled or even medium-skilled and now highly skilled workers. But you can get to a point where you have really well automated factories where it's really about having just a few really super smart engineers and not as much about having this, vast quantity of lower skilled employees. And in such a world, your productive capacity as a nation is less tied to your demographics. Is dollar cost averaging a sensible strategy? Yes, in fact, it's the most sensible strategy for most people in most situations. So if you have a steady income every month with some excess cash, then it might very well make sense to take that extra cash every month and invest it into the stock market. It could also be that you do it every 3 months. It could be once per year, something like that. But just steadily investing over time. Some of the years will turn out to have been really, well-selected years. Other years will be like, oh, maybe I should have skipped that year. But then when you average it out over time, you get, what the market delivers in good times and bad times, and you add it all up. Historical average, it's been really, really good. Now, if on the other hand, you have a lot of cash earning a relatively low interest rate compared to inflation, then it might make better sense to invest a large part of this into the stock market immediately rather than sort of investing that slowly over time. Because, the longer that money just stays as idle cash, earning that low interest rate compared to inflation, the more you sort of might lose out on average year by year. No, the next year could be a terrible year for the stock market or a great year. But if it's on average more likely to be a great year and on overall give that 7% per year something, then every year where you're not doing that, you're losing that difference, and that's really not nice. What do you think about the Magnificent Seven stocks? So I think they're all really amazing companies, magnets for talent, really, really great, undervalued, and I think they have great potential to become much, much bigger. Now I have very different levels of investment in each of them, and they're yeah, in Nvidia is the one that I like the most. Has tech reached its peak? So I think no matter how you approach the question, the answer is no. Firstly, the human level of technology has not reached its peak. Technology will become better and better and better, and it'll become more and more important. And the big tech companies that are, not just great at the current tech stack, but also building the next one and have potential to set themselves up really well for the next stages of technology, they can continue to grow their business really significantly. And I think we are reaching sort of a point where you can just have some companies that can create extraordinary amounts of products and services for a much with a much smaller employee base and with a much smaller base of capital, which can create an absolutely tremendous profitability picture in the long term. And so the tech companies that will be in the position to reap what is now sown for that, yeah, they're really, really good. And I think it's I would not worry about big companies not being able to become bigger. Big companies can become bigger. That was all the questions that I received in advance. So thank you very much for watching, and see you all on eToro, and yeah, let's have a great quarter.